Why people fear mortgages and why you shouldn't.
Coming right up.
Hello Tampa Bay, my name is Barry Horvath and this is Moving Forward TV, your local real estate and mortgage update.
And I am DeLynn Gaston. Thanks for joining us today. In today's show, we are going to be talking about, for years, I've been doing this business for over 30 years, and I have been telling people, make extra mortgage payments each month, put a little extra down on your mortgage each month, pay your home off faster. My eyes have recently been opened to the fact that there is a better way to strategize people's financial futures.
In fact, over the next few weeks, we're going to share some secrets and strategies on this topic. So the American dream is to own your home outright, is it not? For some people, that's a sense of security. So after 30 long years and 360 mortgage payments, that mortgage is done. That home is yours. Isn't that a sense of financial security? Well, for some people it is, but reality might say differently.
So is it really the best thing, paying off your mortgage or paying it early? And if so, if the American dream is so wonderful, then why do thousands of very financially stable, secure, wealthy individuals, Americans, in fact, our statistics show 83% of them still carry mortgages. These are the people who can very easily pay off their mortgage by writing one check, but they opt not to. So our minds are going through some very mixed signals here, it seems. Home ownership is very exciting, and it's a very happy emotion that people have. However, paying a mortgage, people get very depressed about that, the thought about that.
Is that part of paying the mortgage?
That's the dying part. People feel they're dying when they're paying a mortgage, but they're really not. And it's a happy thing. Owning a home and having a mortgage is just part of it, and it really is better for their financial future. So why then, Barry? Why do people have these mindsets to pay their mortgage off early and get rid of debt?
Let me tell you why, DeLynn.
Okay.
It's very simple. Actually, if we go back into the 1920s, the average home in America was actually $5,000. $5,000. Okay.
People pay that for a TV these days, right?
A good TV.
A good TV.
$5,000's a good TV. So.
See, I got your TV in there.
Thank you, but that was coming later. I wasn't ready for that yet. But contrary, just because the average home was $5,000, the average annual income in 1925 was $1,434. So really,
That's like a weekly paycheck these days.
Well,
and that was a year. A year. That was what they lived on.
Don't we get paid double that for doing this show? I forget.
Yeah, we do. Big bucks.
But anyway, that was the mindset of people still back then, still had to have a mortgage. Even though it was only $5,000, they still had to have one because the income was so low.
It's all relative.
But the banks had in place what we call a demand feature, which basically said that at any time, even though you were making that, how much is a payment?
$24 a month.
$24 a month.
$24 a month.
Yeah, if they're paying $24 a month, they could still actually call your mortgage. They could just say for no reason at all, you know what, DeLynn, you need to come in today. We need our $4,500 you still owe us on that mortgage.
So even though they're paying their mortgage payments, their whole $24 a month, they're paying their mortgage payments, the banks can still just at any time for no reason just come in and call the loan.
They can do that.
Which is what happened in the Great Depression.
This was back in the 20s. But of course
the run on the banks.
But of course today the banks can no longer do that.
Right. We don't have that feature anymore. The banks cannot just come. So the whole thing, the whole reason why, and it really does stem from our parents and our grandparents. Our parents told us, and their parents told them, pay off your house, pay off your house, pay off your house. Little debt, and little debt is good when it comes to credit card debts and everything. But when it comes to a mortgage, we want to have a mortgage, and our parents did that because of what happened. It was a big fear. So the whole thing is pay off your loans quickly so that the bank doesn't come and take your home. It was a big fear factor. And that fear factor really has been eliminated in today's, after the Great Depression, they put things into place where now they're not just calling loans for any reason at all.
In fact, did you know they actually had mortgage burning block parties? So when you paid off your mortgage, the whole street would literally, from what I understand, I wasn't there, I'm not old enough, but that they would actually have a party. They paid off the mortgage. It was a big celebration.
Nice. I did that when I paid my car off. Yay. Okay, we are going to take a look at why you should have a mortgage. This is an actual case study, other than the names have been changed to protect the innocent. Ebenezer Scrooge and Donald Crump.
Oh, okay. Now, both of these people, who obviously are not real people, have exactly the same aspirations. They're both buying a home. They both earn about $35,000 a year. They both have $12,000 in savings, and they both want to buy a home for about $120,000.
Okay, very normal circumstances for today's world. So let's take a look at Ebenezer first. Ebenezer, he wants to minimize his loan. So he wants to take all of his $12,000 in savings and put it for a down payment on his house, which is fine and great. He thinks that that's the best way, have a smaller loan. In addition to that, he's going to take an extra $50 a month of his residual income, and he's going to add that down each and every month. Now, with his big down payment, he also takes a 15-year loan because he wants to try and get rid of this mortgage as quickly as he can. His monthly payment's probably about $900 a month. In addition, like I said, he's putting the extra $50 a month on top of that. Now, interestingly, a side note on this is because he's doing a 15-year term, that about 50% of that, maybe a little 60%, something like that, is tax deductible.
So let's talk about Donald Crump. Dun, dun, dun. Donald Crump, on the other hand, he was a little different in his strategy. Donald Crump only put down about half of his savings, about $6,000, and Crump took that big, long 30-year mortgage, 360 months.
That most people fear and shouldn't.
But Crump mortgage payment, it was only about $700 a month. And in fact, instead of taking that extra $50 that Mr. Ebenezer over there put away into his mortgage, Mr. Crump wisely put that money away into his own savings. So what are the results of this strategy? Well, now here's where everything really gets good. So suddenly, let's say, both of them find themselves unemployed. Does that sound a little familiar? Ooh, that never happens. Out of a job. Now, because Ebenezer used up all of his savings as his down payment, and he put his extra money each month towards it, he now has $40,000 in equity in his home. Hey, great, good for him, right? How are you going to get that out? But he's unemployed. So he can't get an equity loan to access that $40,000 in equity. He has no money in savings because he's been putting everything into his mortgage. He can't refinance. Again, he's unemployed. You got to be employed to get a mortgage? You have to be employed to get a mortgage. Ooh. So now, how's he going to feed his family? How's he going to pay his light bill? How is he going to do this? The very thing that he was trying to avoid, losing his home, might just happen because he can't afford his mortgage payments. But now Donald Crump, on the other hand, Donald Crump has about $12,000 now saved because he put less money down and he invested in himself, putting that extra $50 in his own savings account. So what is he doing? Well, he's probably laying there on the couch, hanging out, not too worried. In fact, he's got enough money saved that he could probably make his mortgage payment for the next couple years. Big difference. So what would you rather be doing? Maybe watching Monday Night Football, Sunday laying on the couch, or struggling and worrying about your bank foreclosing on your house? Tell me that doesn't take the fear away. Doesn't take the fear away from me. I want to watch football. That's all there is to it. Football. I'm a Crump guy. Yeah, I'm a Crump person too. I stress this. Many people think they'll be more financially fit if they pay off their mortgage. They are simply just misguided. This is very important information. We appreciate you watching this show. That's our show this week. Please forward this show onto your children, onto your grandchildren, onto your maybe young first-time home buyers. This is very important information that people need to know about, especially our younger generation, so that they can start thinking now about their financial future. And even if you're later in life, it's not too late. This really is some really good information that we wanted to bring to you. We're going to be bringing information to you over the next couple of weeks about the best strategies to do that without hurting your pocketbook. So don't forget, share this out on Facebook, Twitter, as DeLynn says, send it out to everybody. Send it out to your grandparents, because they might agree with what we're telling you here, and that's the past. So.
Right. And if you have any questions on this, Barry is a licensed financial planner as well. I know he doesn't like me plugging that, but he is. So if you have any questions on this, our phone numbers are here, our emails are here. By all means, feel free to reach out to us. Also, we want to thank our partner page over here. These are our partners. They help us get all of our stuff done each and every week, each and every month, and I know they can help you as well. Then, thanks so much for watching. We are Today and Every Day
moving forward.
We'll see everybody next week. Bye-bye.